Good day, fellow investors. Over the last years, I got a lot of questions about mail stocks, but also through the research process and my lists, I constantly came across these very cheap, very high yielding mail post stocks. And in this video, I want to discuss Royal Mail or International Distribution Services, DHL, Post.Nl, and Austrian Post as 4 stocks to see a little bit why are those companies' stocks so cheap and whether it makes sense to find value there and invest in those. I wanted to do this research for my personal investing things. I started this by looking at Royal Mail as I'm going to the FTSE, complete list of stocks by stock, and then I look into something interesting, looking at sectors. We did the chemicals a few days ago, last Sunday, with BASF, how you call it, we'll never pronounce it well. But let's start with the stocks and the stock prices to see how cheap those are. So International Distribution Services of Royal Mail, better to say it, is close to all-time lows since the IPO, down was 66%, but huge dividend yield and market cap of 2 billion. Deutsche Post or DHL is better, P ratio of 10, still good dividend yield 4.28. The stock is doing a little bit better, but not even as stellar as one might expect. Post.Nl, greetings to my Turkish delivery guy in Vladikum a few years ago, he was so funny. But look at the dividend here, 9.45%. Market cap 822 million and the stock really going down. There was someone trying to buy it out or something here, but that likely didn't work. Let me know in the comments if you know the story there. But it looks extremely cheap now, the distribution of mail in the Netherlands for less than €1 billion. The same thing in Austria, 2 billion euros, dividend yield 5%. The stock doesn't do much. So let's check the businesses, then the finances, value what we can value, and discuss the risk and reward of the stocks. If you enjoyed this analysis, smash that like button. And also check my research platform if you want to see what I invest in and more of these researches that don't come to the YouTube channel. Now, Royal Mail, GLS, they merged or something. And immediately, if you look at the first slide of their presentation, you see Royal Mail's lack of flexibility damaging both company and group. So that's the issue there, strikes, and you can see here the profitability with and without the strike impact. And of course, they went public, I don't know who got the money there, but when you have such a not flexible workforce, with constant expectations and the power to go on strikes, it's very, very hard to deal with that if you don't have Al Capone solving those problems. And yes, their plan is to transform everything and then grow profits, and that benefits offset pay over 2 years, somehow to do those things, but still, they need to invest also as the competition is not staying still. However, they want to lower debt and then also invest here. But except for Royal Mail, GLS is doing well. However, I don't know how will this deal work, because when it comes to strikes, unions, you give something, they can always go for more. It's very hard in a very competitive environment to give more, pay more, then you are not competitive and the competition might take you over. GLS is doing well, however, Mail UK, GLS is also competing then in Europe with DHL. That is doing great on express, global forwarding, supply chain, e-commerce, post and parcel in Germany. And they are making this ecosystem. You see all those trucks going up and down Germany when you see it. They work on globalization, digitalization, e-commerce. So focusing on creating something more of a network globally, Americas, Europe, market share growing, 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 growing. So when it comes to this market, this also explains a lot of things. The players that can scale, integrate, create an ecosystem will be the winners. It's like Amazon and everyone else. The winners take it all, so the small ones might lose and the bigger ones might gain. Therefore, when you look at this, this already looks interesting. Of course, when you look at businesses and you see what's going on, okay, the pandemic did what it did here, now it's returning a little bit to normal, maybe even signs of a recession in Germany. So also tells you something when it comes to investing. But if I look and compare Royal Mail and the others with DHL, the company looks much, much better. So it's on a growth trajectory, it's investing a lot, as we'll see later. It's investing more than the market caps of all these others per year. So Royal Mail cannot compete. They have strike issues to deal with, while these guys think about warehouses, logistics, technology and everything. You know the story, you know, we all know how the story will end there. Similar to Post.Nl, so they have their ideas, they want to do the international, so someone put a nice presentation in it, but how are they going to compete with bigger players internationally? Not with Jos and Joop riding bicycles or this. It's a bigger game, it's a different game. A presentation might give them some equity, something, but very hard that they are going to take advantage of the McKinsey global base case and bold scenario for e-commerce growth. DHL will take them and the other players. Brands I never heard of, Spring Delivery Solutions, they have Spring offices, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 offices. So that costs you, I don't know, 100 grand a month to open, but it's a great story. Doesn't work. Austrian Post, same thing in Austria. We'll discuss it a little bit later in Valuation. They try to expand a little bit southern, build something, but the mail trend is going down and the bigger ecosystems are taking over. So it's hard for smaller players, but let's check the financials. Royal Mail, they are thinking of net debt, long-term group retained earnings, okay, look positive. Oh, sorry. Net debt is negative, long-term group is okay. When I look at this, operating leases, net debt, that's already 2 billion, that's more than the market cap, so not really very interesting for me. And yes, the plan is for turning them back to profit, but what if it doesn't happen? What if the economic situation doesn't allow it? It's too risky simply to do. Maybe it would be better to split the combination there, which is an idea, give this back to the government or something, but the value has already been destroyed, cut the dividend, of course, revenue decline on economic downturn, industrial action impact, so not good, not good. Okay, the other company, GLS, is looking good. They're doing their own thing, so growing. If they can keeping market share there, all well. But when it comes to this business, with the issues Royal Mail has to deal with, they have a lot of issues that they are losing ground on with the competition, just taking away that market share. So very ugly situation. Maybe someone will take them over, but who in the right mind would take them over when you know you're going to deal with strikes, unions, etc., etc. So at some point there will be value, something will happen, 20-50% up, but too risky to even play with that. On the other hand, Deutsche Post, Global Express, air freight, ocean, parcel, Germany, contracts, logistics, warehouses, whatever you want, buybacks, strong cash flows, 4 billion. They can eat up all the other smaller players in Europe with 1 year of free cash flow. So that's insane. Growing globally. Net debt around 14-15 billion. That looks okay. They have been growing on that parcel trend growth. really well over the last years, also growing net income. They are managing to be profitable. They have shifted from Post and Parcel to DHL. Really masterpiece what they have done here. EBIT 6-7 billion, continuing to invest in the growth, good return on capital employed. Target invested in long-term growth, 4 billion just every year. A little bit lower capex guidance, but still investing 3 to 4 billion into those warehouses. So the other smaller players cannot compete with that. Very high EBITDA, some debt, but nothing scary. So from the businesses, Deutsche Post looks really great from a business perspective, but also 4% dividend yield. Let's go into the valuation. Post.Nl, declining parcels, declining volumes in the Netherlands. They still have a dividend, but the free cash flow is down 86%, just 40 million. And then you also think about the trend, where it is going, the balance sheet. They have no equity, I think. Very little equity, 177 million, and there are some intangible assets, what I don't know. So negative equity practically, if you look at it. Also goodwill, other intangibles. So another thing with Post.Nl, if someone can take it over, sell parts, pieces, there can be some value, these prices, these bottom prices, but that's really Benjamin Graham style. These smaller post businesses would be Benjamin Graham, just buy on the value, but there is no book value. So very, very difficult situations. I'm not a specialist in those difficult situations. Austrian Post, Österreichische Post, okay, looking good, but still 97 million cash flows on a 2 billion market cap, 4-5%. They are paying it all out in dividends. So dividend plus unlikely growth because of the competition. Okay, solid balance sheet, owned by the government. Keep in mind they have their little bank and everything, so less risky. But again, they don't have, owned by the government, they don't have that DHL DNA, let's say. I don't know if DHL is also owned by the government. I think it's pension funds mostly, but someone is doing a good job there. Let's do valuation. Operating profit in 5 years, value after taxes 200 million. Even if that with a P ratio of 10 is reached in 5 years, 2 years, 3 years, that's still 2 billion. That's the market cap now. So too risky. Who in the right mind will want to mess with this? So 2 billion, maybe in 5 years the value will be 2 billion. Leave it to pension funds or something like that. Deutsche Post, P ratio 10, growing steadily, net income growing, stable market share, gaining market share. They do their free cash flow around 3 billion on 50 billion. They plan to grow, they increase those dividends, payout okay, the rest is for growth. So if I look at that dividend growth, 4%, if they can reach 4% growth, maybe a little bit too conservative, that's a 6%, 4 plus 2, 6% long-term return. That's okay, but then I would again wait for a crisis in Europe, and then maybe you can get an 8 to 10% return from what looks like a good business. And here is the summary. Unlikely success. Who will take it over? Who will take it over? Small, nothing wrong, but nothing special government. And this is the only good business out there. So that's something to think about. Why those mail stocks are cheap? Because there is a lot of competition in a declining market. Well, where the winners are a few legacy limitations. So it looks like the winners will take it all. DHL, other companies maybe. So it's an interesting sector. Well, the smaller ones will disappear, like your local shop, all going to the big Lidls and Aldis and who knows. That's happening also to the local posts. Some are helped by the government. There will be refinancing, strikes, ugly issues that you don't need as an investor. DHL looks good, but nothing spectacular. Base case scenario, 8% return, which is good. So a good company to add to the portfolio if you have a diversified portfolio of good companies. But That's about it. For me personally, nothing to follow on my research platform. I want better than DHL. Maybe if it goes lower and I feel that there is a structural trend where the infrastructure is really valuable, but it has to go lower. And then if it goes lower, other things will go lower. So that will do more than 2x when it jumps, that it's DHL's possibility in a recession. I'm not caring about the 4% dividend. I can get faster growth with higher dividends. So that's the story. Hope you enjoyed. We at least know why those things are cheap, because they are losing market share, losing profitability, and that's it. Thanks for watching. I'll see you in the next video.